Okay, so how about access to capital? This is part of our insurance stock continuation from another video of how much does it cost. So there's two reasons to take a loan against a policy. One is for major capital purchases, so anything you can't pay for in full with your monthly cash flow. That's a major capital purchase. Or investment opportunities with potential to make more return than offered through the policy. We hear a lot of talk about investments these days. Where can we go to get better returns or get access to good investments? Well, we need to fund those. So this might look a little bit different, but there's a reason for this. So down here, the gray pipe represents all your income coming in. Up here, the copper piece or the valve tells us how much we're going to put toward future lifestyle. So that's money you put away for later, right? And then the outflow down here is just what you use for your regular lifestyle. So let's get this tank rolling. So over a lifetime, we're going to have money coming in. We're going to have a lot of it going down for taxes. That's this red arrow going down. And then we have a bunch of the green here coming out for outflow. But it's this future lifestyle. It's this money that we put away that we're going to talk about today. So we're going to put away some money and we're going to use permanent life insurance, our safe tank. So as you see in the green there, we have a safe amount that represents cash. And then up to the top of the blue represents death benefit. Okay. So as these cash values increase, death benefits and access to capital also increase. So policy loans are collateralized against the cash value. What do we mean? Well, we're going to go to the insurance company and say, hey, take a look at my policy, see how much cash I have in there. The company says, okay, good. We will loan you some money, and we're not going to ask you what you're using it for. We're not going to do a credit check. We're not going to report it to your credit bureau. We're going to give you a loan solely based on the collateral of the cash value in your life insurance policy, because we know you're good for it because we hold it. So now you've got this liability of the funds that you borrowed, right? So, what could we use that for? Well, if you notice this little gem down here, major capital purchase. What if it's time for a new vehicle? So when we structure this now and you take your loan for your new vehicle, you're going to make loan payments. You're going to make them just like if you're making a car payment. Well, where you're going to be paying them, instead of to the bank specifically for that car loan or to the car company, you're going to be paying them back to the insurance company that you borrowed the funds from. Okay, so as you notice the flow now coming, we're still going to have some for tax, the red line going down with the blue line. We've now put even more money back into our tank. And why is that? Because as we pay back the insurance company and the debt goes down from the debt tank, then they release the collateral on our insurance. But not just that, it continues to grow with deposits and dividends. So now we have an even bigger tank for future use, perhaps a mortgage next time, right? So the loan payments are made to the company, not to the policy. But as a result of paying the company, it releases the hold or on the policy. So internal growth, as I said, and additional contributions increase the collateral capacity. So this thing grows even bigger for bigger availability to cash. Again, when you want cash, what's the criteria? You've got the cash and then you ask for it. You do not have to qualify. Okay. So let's say you want policy loans for investments, right? Investments are represented here by the risk tank. Your policy is represented by the safe tank with the permanent insurance, and then the funds you can borrow from that. So let's get this running, see what that looks like. So again, we put money away towards our future. We build up that tank where we've got some cash there, a good amount of cash build up. We've also got a death benefit. So we've got our safe tank with permanent insurance. Now we want to do some investing. Now, let me go a sidebar here. If we had just done this in, say, or TFSA or whatever, and we decide to take it out, if we need to take the money to invest, we're going to reduce our TFSA or boil it down to nothing, right? If you do not interrupt your policy and the insurance company will give you a loan against this safe amount, this cash value, then not only do you have the means to invest, you also have your money continuing to grow uninterrupted. So let's chat more about that. So no restrictions on the purpose of the policy loans. We say investment, but this could have been to go buy a capital purchase. Either way, we're gonna roll it investments. So your policy loans are collateralized against the cash value. Again, you're not borrowing your own money, you're borrowing funds from the insurance company as shown here. You have a liability, so they hold a certain amount of collateral. Notice the blue there, right? So the difference between the collateral they hold and the top of the tank is access to cash that you still have. You've now borrowed that money and gone over here to the investments and made some investments. Now those are going to be more risky, but can you absorb better risk if you know you have safe money? Well, the answer is yes, right? We don't do the risky tank to lose our money, but the possibility is things could be up or down, could be down when we need access to money. But having the safe tank always gives us better options. Plus it continues to grow here. So if this grows, this is definitely going to grow. And if this is not growing on the risk side, this will continue to grow. So the loan payments are made back to the insurance company, again, not the policy, because you don't borrow out of your policy. You borrow with your policy as collateral. So as you do that, if you notice your blue is gone because you paid back that loan, your safe tank gets to be huge because it continues to grow every single day and it cannot go negative. And as long as that flow of money isn't interrupted, it continues to grow. So internal growth again, and these additional contributions increase your collateral capacity till that thing is just massive. Just give it time, it does what it's supposed to do. You now have no loan and you've got your safe tank that continued to grow and you've got money in your investments over here. So instead of choosing, you get to have both. All right, so we're going to look at potential for increased return from investment opportunity, because given enough time, and if we've selected well, that will grow as well. So let's look at this now. You've got your policy with huge cash values, you've got the insurance company, and you've got these major purchases you can make. You know, let's say a vehicle or investments. You get an interest-only loan. Now, guys, interest only. Okay, that's all that is charged. You have non-structured payments. Notice I didn't say the interest what was required. Let's say we have a situation that nobody expects. Oh, I don't know, like say COVID-19, where the whole world got upended. Let's say you had done this through a traditional car loan at the time. You would have had that specific payment you would have to make each month. Well, because you used your policy as collateral and got the insurance company's money, you now have the flexibility of not having to pay for those time periods when things are just too crazy. That flexibility, remember we said use and control before? This is huge. This is huge. So now you can take a holiday from payments as you determine and then get started again when things smooth out a little bit. Okay, that is huge. You have use and control of those funds. So yes, there's still interest, but there's no required minimum, like say your credit card, your car loan, or even a home equity line of credit would have a minimum payment. So permanent life insurance, when designed and utilized properly, can provide stable growth, cash value collateralization, as a mouthful, guaranteed loan access. Again, let me repeat that because I don't think it's stressed enough. Guaranteed loan access, no annual tax on growth and death benefits. Your policy continues to grow in a tax-free environment, and additional benefits are available with additional policy riders. It's all in the setup. So that is how we not only choose the insurance that is the higher, because we're choosing it for a different purpose. We're using it for all those benefits we had before, but that shows how you can access the capital with the control and flexibility. And that makes this a fantastic way of life. Thank you for your time. Appreciate that.
IBCanada Group, your independent authority for information on the infinite banking concept.